Hage needs a 2-putt bogey to win here on number 72 at the Rusty Putter in St. John. Ooh. He zips that one past the hole, and with that tap in, another 3-putt puts Hage and Perri score through 72.
Well, look at that. Not on time, as usual. But here we are. Welcome to Tony's humble home office. It's a little deviation from the Rusty Putter today. Adam's out. Didn't have any guests scheduled and wanted to give you just an inside scoop on some interesting data that we received from Redfin recently about why first-time home buyers are waiting or putting off a home purchase. And sometimes what happens is you just get caught up in media rhetoric and you don't talk to professionals. You don't talk to industry insiders, people who are in this every day, that can help you uncover programs, access, information that exists that directly helps you overcome these objections. So we're here to cover some of that today. We'll go through some graphics because everybody knows I love charts, and then we'll talk about what's to come. As far as what we're going to talk about here, Redfin published a report about reasons prospective first-time home buyers are waiting to purchase a home. One of those first reasons, I'm currently on track in my financial savings to purchase a home in the next year, just not right now. I think as I've talked to many home buyers and prospective home buyers, there is a profound misunderstanding about PMI. PMI is not a 4-letter word. It is not a swear word. It's not a swear word in church. It is an excellent financial tool if you have good to great credit. Why? Well, my slide's a little misformatted here, but I have a customer right now who has a 720 credit score. They are putting 5% down and buying a house that has, it's going to end up with a $489,250 loan. In this exact case, here's the calculation for what their monthly PMI is going to be. $489,250 times 0.0038 divided by 12. $154.93 a month. Well, why is that I guess no one wants an extra $155 a month coming out of their budget or added onto their home payment. But when we're talking about the difference here of the additional $77,250 that this person would have to come up with for down payment and closing, just down payment, not even closing costs in this case. So what could you do with that extra $77,250 to avoid PMI? Does that allow you to buy a house that might be not updated to your standards and you want a new kitchen and new bathrooms? I think you could probably get that done for $77,000 in most cases, as long as you don't go crazy on your cabinets and your countertops. Can you finish the basement? Everyone loves a good idea of a man cave, right? I certainly would love one. Does $77,000 get you the man cave you want, the golf simulator you want? Or what about this? At Novus, we're a division of Ixonia Bank. What if I told you that we have a money market account that has a 4.75% yield on it right now? So we could take your $77,250 that you could have put down to save, you'll save money on interest and all of that stuff, but just the PMI cost, if you yield 4.75% a year in this money market account, it's $305 a month in interest. You're going to be ahead. So the idea or this perspective or opinion that PMI is a 4-letter word in church is not always the case. It doesn't mean that PMI is always the right thing for every situation, every buyer. If we don't have credit in the 700 plus range, it does start to get expensive. But at this point, it's overcoming needing $77,250 of additional funds or liquid funds for a down payment. To me, I'll pay $150 a month to keep $77,000 in the bank all day, especially when my 77,000 could yield 4.75% in a money market account. We're not talking about something that's not FDIC insured or FDIC backed or anything like that. Or I guess we're talking about something that is like that. We're not talking about something that's tied up in stocks or crypto or something like that. So PMI, it's a great financial tool for a lot of people. Don't let this fear of 20% down payment or needing 20% down or PMI is the devil. Don't let that push you away or press you away from wanting to buy a house right now. That's kind of crazy talk. So we go back, right? Let's go back through our list here. The timing works better for me and my family, or my partner and my family. We hear this one all the time. I will tell you that in the last 3 months, we've closed loans for families whose landlords have decided they were going to sell their homes. It's happening at an alarming pace. So although the timing might not be right for you to actually buy a house or execute in the next 3, 4, 5 months, it does not hurt to start the process, having a conversation with a great real estate agent and a great mortgage person, so that when the timing does happen or timing changes or situation changes, you're ready to go and you have a grasp on what you can afford. And maybe we've been able to overcome some of the hurdles, get credit cleaned up. And we have a customer that closed on a house earlier yesterday, actually. And when she started the journey with us at the beginning of the year, had a 622 credit score. When we closed her loan yesterday, she had a 699 credit score. Again, it's just having the conversation. She knew that she had, 3 or 4 months left on her lease, so she wasn't going to start looking until the beginning or middle of summer, and then finds a house and timing all worked out, and she secured substantially better loan terms because she just had that conversation earlier on. So understanding the timing. Time might not be right now, but it's never a bad idea to have a conversation with a professional. Look at your budget, look at things that you could overcome, and see what it is going to look like. Because if your landlord decides one day he's going to sell that house, or you need to get your kid into a particular school district, or you find out the wife or girlfriend or significant other is pregnant and now you need another room, another bedroom, we got you covered on that. This other one here was really, really interesting here. I am waiting for the Harris housing plan to come into effect with the $25,000 down payment assistance for first-time home buyers. We have 26% of overall first-time home buyers waiting for that. 33, just under 33% of people who identified as Harris voters. And we've talked about this a little bit before. The United States has frequently subsidized housing and provided programs and outlets and alternatives here. But what that does is two things. It is going to, one, bring potentially 33% of first-time home buyers that identify as Harris voters to the marketplace, or 27% of overall first-time home buyers, pressing them into the marketplace potentially. Again, we already have restricted supply. Demand goes up, limited supply, prices continue to rise. Affordability becomes an issue. $25,000 in a lot of cases is not going to get you a substantially lower mortgage payment. And let's talk about this like real in depth, right? So this program would require congressional approval. Let's talk about this. You've heard us talk about trigger leads and opt-out pre-screen and how Experian, Equifax, and TransUnion love to sell your private personal data regarding your credit inquiries and soft inquiries and potential motivations to move to data aggregators so that they can utilize the thing the term in our world is called trigger lead. Congress has not been able to pass an act to protect your personal credit history in 8 years. The current bills right now are tied to a defense spending bill. So if they can't protect your credit inquiry history, how in the hell do we expect them to put together a $25,000 down payment program at the drop of a hat? It's not going to happen. You want to know why it's not going to happen? Because these things hide in plain sight. There's already a down payment assistance act in sitting in the House Bill 4231 and Senate Bill 3930. The House resolution was published June of 2023. So it's October 2024 now. And we got a bill in the Senate here since March of 24 as well. These things are not fast moving. Again, we can't protect over several years. We cannot protect your credit history. So how are we going to give you 25 grand? The other thing that we really want to talk about here in these bills, in any type of subsidized or perceived affordable housing programs, there's always a clawback or a holdback. There's never free lunch. I promise you. If I go back to anyone from my Trinity Christian College days, they'll tell you about one of our professors who would always tell us there's no such thing as a free lunch. In these bills, there's a proposal for shared equity homeownership program. The term shared equity homeownership program means affordable home ownership preservation through a resale restriction program administered by a community land trust, other nonprofit organization, state, local government instrumentalities. You take money from the government, they want to share in your equity. A lot of times you're going to actually waive your right for your exemption to capital gains on the sale of a primary residence when you take these bond loans. But again, right here, shared equity home ownership, you're sharing your equity with the government. So your $25,000 that you may or may not get, the government's got their claws on that, whether it's via recapture tax, the shared equity program. Again, don't let this idea fool you or let you drag out a decision. Why? If you're buying in Illinois right now, I can get you, again, you have to qualify for it. There's some terms and restrictions there, but I get you at least $10,000 in down payment assistance. Are you buying in Indiana? We can get you 6% of the purchase price of your home in down payment assistance if you're a first-time buyer and you meet all of the credit criteria. Is your income over all these state program limits? We have a program that's federal, and we can get you 3.5% of the price of your house in 47 states. So if this $25,000 eventually does come to fruition, it's going to bring 20 to 30% of first-time home buyers that are sitting on the sidelines off the sidelines into the marketplace. Again, supply and demand. You can't build houses fast enough, so demand builds up, supply is restricted, prices run away. And then you got to share in your equity, more than likely, with Uncle Sam or Uncle JB or Uncle Eric Holcomb or Uncle insert random governor's name or mayor's name there. As it says, these things are going to have clawbacks and shared homeownership equity agreements on them. Don't let that stuff fool you. I promise you, it's not worth it. So going back, right? So we've covered at this point the $25,000. I'm waiting to see if my city or state will provide more affordable housing initiatives. Your state already has them. Every state in the union has a housing finance authority. Particularly, we work a lot with Illinois and Indiana, where my office is located between, we have one in Mokina, one in Crown Point. Every state has these programs. They're accessible. They're navigable. We participate in a lot of them. So waiting, again, are you waiting because you just don't know that a program exists? Talk to a mortgage person. We can find a program that may fit for you. There's also just general loan programs, right? Buying in a rural area, we can look at a USDA loan, no money down. We can overcome that. A lot of times these affordable housing initiatives are not real affordable housing initiatives for homeowners. A lot of times they are condensed rental units, government sponsored or government subsidized housing for rent. So that's their home ownership program doesn't exist in a lot of those situations, right? I'm waiting until the presidential election to see how the economy fares after that. That's completely legitimate. I am not going to tell you by any means that you shouldn't consider that, particularly if you're in some industries that, if the election goes one way or the other, could evaporate or explode. That part completely reasonable there. Again, it's holding back 23% of buyers at that point. The other ones that we can control, I'm waiting to see if the federal government enacts any affordable housing initiatives. We just talked about this. It's not reasonable. It's not going to be on a reasonable timeline. So, we've heard in the debate about allowing or making it easier, accessible to build 3 million homes. It's just not, that's a triple the pace of what exists in the United States, right now. We live in a free market economy. If there was that much more money to be made, that and the ability to build houses at that pace existed, it would already be happening. So don't let that stuff trip you or trick you up, right? And then you're going to rush into one of these programs. It's just not going to happen. Then you have these clawbacks. You don't actually own all of that equity in your house that you're building up. I'm waiting for, again, so we have to have a Harris idea and then a Trump idea down there. But the other one we want to talk about real quick, and because it's created a lot of chaos right now and confusion for consumers, understandably, is waiting for the federal funds rate to be cut again to drive down interest rates. Again, this stuff's all readily available to you. This is actually from the Federal Reserve Bank. This is a chart that tracked federal funds, the high end of their target Fed funds overnight rate, and the average 30-year fixed rate mortgage as reported by Freddie Mac since 2015. Is there a correlation here? Yes, there is a correlation here. Is it as direct as everybody anticipates or looks? Not necessarily, because look here, in 2018, we see Fed funds rate hikes, and then we see interest rates drop down. We also see relatively static period here during COVID when Fed funds rate 0. Rates hover around 3.5%, because that's the fundamental minimum, right? Then we see Fed, they go through their rate hike cycle, rates pop up, but then, they level off, and we see a spike, a drop, a mini hump, a drop. There is not a direct correlation here. We're fighting against a lot of other things and a lot of other economic data, inflation, jobs. And I think I saw this morning that Goldman Sachs maybe came out, or one of the big investment banks came out and said there's less than a 15% chance of recession. Fed funds, and I always want to talk about these charts, because if you go start looking at these, you'll see there's always these gray bars in them. That is when the United States is in a recessionary period. That's what those gray bars are. That's why you can see the Fed fund rate bottoms out here, right? And it drives down interest rates. Well, the term soft landing is coming out, right? So we're talking about soft landing. That means no or very protracted recession. If we don't have extensive recession, we're not going to see substantial Fed funds rate cuts. It's outside of their purview. Their goal is to maximize the employment market and keep inflation at 2%. It's a stated goal. Waiting for the Fed to dictate interest rates is not going to be the best plan for you. Are rates a little bit higher than historical norms? Sure. Does it drive up your cost of owning a home? It sure does. But there's a lot of other things that you can do to overcome this. We've talked about this one before. $300,000, 0.5% on $300,000 over 30 years is $100 and change a month. If you eat out for lunch 4 days a week, all right, and you figure on 4 days a week, you're spending at least $11 on lunch, all right? It's $44 a week times 52 weeks. It's $2,288, okay? That's just on lunch. We divide that across 12, right? It's $190 a month. I've just helped you overcome a 0.5% interest rate adjustment on a $300,000 loan. Yeah, who wants to eat peanut butter and jelly 4 or 5 days a week, right? And not everybody, but have I done it before? I sure have. Do I know a lot of other people that have done it? I sure do. And it's because they wanted to buy a house. Buying a house in a higher interest rate environment takes a little bit of sacrifice, especially when prices continue to climb. The things that we cannot control, where prices go, right? If there's still demand, limited supply, price has to creep up regardless of interest rate. We've seen prices escalate with rates in the high sevens, low eights. When rates, eventually trickle down to low sixes, middle fives, we are going to see prices escalate again. Where you win, amortization and appreciation. Buying now so that house continues to appreciate in value, and you're only borrowed 95% or 90% of the price of that house today. So now you're continually paying that mortgage down, amortizing that mortgage, creating your net worth and your wealth. That's my rant. I know we didn't have any agents on today. We didn't have Adam on today. Sometimes we just want to get technical about some things, but just know that if you want to buy a house, don't let the media steer you to these ideas of interest rates are what's causing unaffordable home ownership. And I was laughing last night. I was talking to my wife Megan, and I was also scrolling through CNBC and saw this video about assumable mortgages, and that's kind of what set me off on this idea this morning here. There's companies now trying to help you find an assumable mortgage because you want to take over that seller's 3% FHA rate, right? Assumable mortgages are FHA, VA, USDA. Well, this family's talking about how, that them taking over the seller's 3% interest rate on their house saved them $800 a month. But then when you actually play through and you exist in this industry and you know all of this, that's not a real number. They did not save $800 a month. Do you want to know why? Because on top of assuming that mortgage, they also put 20% down of the purchase price. So the gap between that mortgage and whatever the seller was selling the price for. So what was the cost of that 20%, right? Again, this stuff it's smoke and mirrors. It's trying to stimulate ideas because transaction volume for mortgage companies and for real estate agents is at an all-time low right now. In that video, the one accurate thing that they did cover was that process takes at least 90 days for a mortgage assumption. And person assuming that mortgage has to qualify for that mortgage with that current loan servicer. That doesn't always happen. And again, you're not going to see a lot of sellers that are going to wait 90 days for you to assume their mortgage when they can properly price and sell their house inside of 2 weeks. It's again, this mythical chase. I think I saw last year there was maybe 5,200 FHA loans that were assumed and less than 5,000 VA loans assumed in the entire United States. It's not practical. Don't fall into that loop. Don't fall into that trap. Again, I can't stress enough. We have great real estate agents on the show. I have a Rolodex of great agents that cover pretty much from Iowa, the border of Illinois and Iowa, all the way to Fort Wayne, Indiana, from the southern part of Wisconsin, all the way to Carbondale. My team's got you covered. We can connect you with a great agent that will help you buy or sell a house. They'll be there to have those honest conversations with you. Novus, as a company, we're licensed in 50 states. We have coverage all over the place. If you're looking, you're in Illinois and you need to buy in Florida, 1, we can help you do that mortgage. 2, I got some great friends that I talk to every day at my company that work with great agents in Florida. We have some opinions about Florida and their insurance, but Georgia, North Carolina, Tennessee, you want to go out west, Arizona, Colorado, Nevada, all of those places, we have access to great people to help you make that jump. End rant, end all that stuff. The best way to get in touch with us, 630-284-9729 or applywithjr.com. If you are a real estate agent and you've gutted this thing out for the last 24 minutes, we have an awesome event. A lot of y'all in the Indiana side You guys know Tom Faley in the Novus group here. He runs the Crown Point operation. We have the Mokina operation. Him and I are putting together on October 29th our annual Ask the Appraiser seminar. But this time we're dumping a little bit of gasoline on this thing, and we're going to turbocharge it. We also have Ask the CEO. So we're going to have Novus's CEO, Eric Egenhofer, live in person, in the flesh, talking about what he's seeing in the mortgage world, in the finance world, that's going to help you navigate your 2025 buyer's market and help you educate your sellers going into 2025. The guy is a wizard on charts. He'll put my charts to shame. He'll also break it down into bite-sized pieces that you can give to your sellers or your buyers. So that'll be October 29th in Maryville. We'll post some information and get that out there for you. But hope to see you at that one, and we'll smell you all next week. We got the guy with the same name as me, Tony Perri, on next week, and we'll be talking about the competitive edge again and what you can do. I don't even know what we're going to talk about with them next week. Probably something really fun, though. We'll see you then.